It's essential to check your finances before deciding if you should invest, and I strongly recommend that you do so. First and foremost, an emergency fund is an excellent rule of thumb because you never know what might happen. Even though we are amid a pandemic, it doesn't take long to realize that we never know what will happen, and that we need emergency savings in case we lose our jobs or something else. You should have at least a month's worth of savings in your emergency fund, and then gradually increase that to 3 months to 6 months over time. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. One of the most important things to keep in mind is the importance of having an emergency fund. Even though we are in the midst of a pandemic, it doesn't take long to realize that we never know what will happen, and that we need emergency savings in case we lose our jobs. It is indeed recommended that you save at least a month's worth of expenses in case of an emergency, and gradually increase that amount to 3 months to 6 months over time. In the second part, you need to get rid of any high interest rate debt that you have because money is going to keep going down the drain if you don't address it. 3 options are available when it comes to saving for retirement. The most popular ones are the traditional individual retirement account, TRIA, the 401k, and the Roth individual retirement account, ROTH, Roth. There is a good chance you have a 401k retirement account if you work for a 9 to 5 or other type of job that provides benefits. You are doing great because you are saving for your future by contributing to your 401k through your job, and it is an investment account, so you are doing a good job. If you contribute to your company's 401k, your employer will most likely match a portion of what you contribute to the tax-deferred account. The mutual funds, that we'll discuss in a moment, automatically invest your money in a mix of stocks and bonds. Another option for a tax-free growth in your retirement savings is the Roth IRA account. Terms. For those who aren't familiar, I'll do my best to demystify the terms stocks, bonds, and the stock market for you. So if you want to invest in Facebook, you can buy Facebook stock, which essentially means you own a piece of the company's enormous pie. As a result, your Facebook stock will grow at a much slower rate than that of the company. People freak out about the stock market because it's a place where people buy and sell stocks. In other words, it displays the various ownership stakes in a company, along with their relative performance. Because the stock market is largely influenced by investor sentiment, if there's pandemic, investors may be tempted to liquidate their assets and do just that. That's an interesting fact about the stock market. It's going to drop if a lot of people do that at once. Nevertheless, the stock market will rise again, and if when investors begin to believe that this is a good thing and decide to reinvest their funds in it, you'll hear people talk about risk versus reward. So you'll have to take a greater risk if you want to earn more money. Because of this, you'll have a smaller profit margin and a lower risk, which means you'll make less, but also risk less. That's why bonds fall into that category of low-risk investments. Buying a bond is like entering into a long-term loan agreement with a company or the government. The repayment terms are clear, and you can expect to earn interest on the money you loan them. This is considered a low-risk investment because of that. A fund is a collection of stocks, bonds, and other financial instruments that are pulled together in one place. It's easy to compare the purchase of a single stock to that of an entire bouquet of flowers, but buying a mutual fund is like buying the entire bouquet. Index funds and mutual funds are the 2 main types of alternative investments I'll discuss today. Mutual funds were the first of their kind, and as I mentioned earlier, an investor manages a big old bowl or bouquet of stocks and bonds, who, with a great deal of knowledge of the stock market, is in charge of managing a fund or mutual fund, and they're using that knowledge to select the stocks, bonds, and other investments that they believe will be the most profitable. As a result, you're gaining exposure to a wider range of securities. Let's use the example of buying a lot of Facebook stock and then watching as the stock drops. Your money will be lost along with Facebook. So it's common to hear that you need to diversify your portfolio, essentially avoid putting all your eggs in one basket. In order to invest in stocks while also ensuring a broader range of investments, mutual funds were developed. Typically, these are run by a knowledgeable individual and will cost you a significant percentage of your mutual fund's value. So, if you're putting in whatever amount of money you're paying them, index funds arrived a little later. I, for one, am a big fan. As is Warren Buffett, one of the world's most accomplished investors. If you don't believe me, believe Warren Buffett. If you invest in an index fund, you'll own fractional shares of many different companies, because the fund holds various investments. A stock market index is a sample of the overall market. It's like a mutual fund, but instead of being run by a manager, it's managed by a formula. So instead of a mutual fund where you're trying to outperform the market, You're basically trying to match the market. There are huge savings in terms of time and resources with no mutual fund manager. An index fund is a type of investment that, once purchased, is left untouched for an extended period of time. Keep in mind that index funds are mutual funds, but not all mutual funds are index funds because it's a little confusing. Simply, reinvesting your interest into your original loan or investment is how this money grows, a process known as compound interest. There is no interest paid on mutual funds, but dividends or capital gains may be reinvested to grow your portfolio over time. If you go to investor.gov, you can see a compounding interest calculator in action. Think about investing 1,000 grand in an index fund over the course of 30 years at an annual rate return of 8%. That's a conservative estimate. You started with 37 grand of your own money but grows to 146 grand in 30 years because of compound interest. So, what if you made a larger initial investment, contributed more each month, or opened an account with a higher annual return? If this is your first time learning about investing, you may want to brush up on your vocabulary before we get started. The sooner you start investing, the better. The earlier you start, the more money you'll have to work with. There is a limit to how much money you can contribute to retirement accounts like Roth IRA each year. So, if you earn a lot of money one year and want to put a lot into your retirement account, your options are somewhat limited. If you don't have a lot of money to invest, which I'm sure many of you do, don't worry about it. All you have to do is put in a small amount each month and it will pay off. As a result, you should now ensure that you have an emergency fund. Pay off any outstanding debt and invest in your future. Let's take a look at a few different investment options. As I mentioned earlier, there are a variety of ways to invest. It's possible that you're looking for a more high-risk, high-reward type of person, such as a person who trades stocks and is more hands-on. A more passive approach, like investing in an index fund, is also an option. There are various types of index funds, such as the S&P 500, which is a popular one. For example, the S&P 500 index tracks the 500 largest US companies, but if you're in a different country, the S&P 500 index will reflect your country's top 500 companies differently. Hopefully, some of these fundamental principles apply to you. As a result, the S&P 500 funds you will receive will differ slightly depending on the brokerage account you choose. If you haven't heard of the S&P 500 before, you should check out this fascinating story. Over the course of a decade, Warren Buffett staked $1 million on the idea that an index fund would outperform a group of hedge funds, and he won. He was successful a decade ago. There were a lot of hedge funds out there trying to beat the market by timing the stock market and making most of the money, but they didn't succeed in doing so. Index funds, which allow investors to sit back and watch the market rise and fall, performed the best. You don't need to know a lot to get started. All you have to do is put your money into one and sit back and let it run its course. A total stock market fund will allow you to spread your investments across the entire stock market, not just the 500 largest companies, as the S&P 500 does, but it will also allow you to invest in smaller companies. So that's a brief introduction to index funds, which are highly recommended, but you have to make the decision for yourself. So put in the time and research if your finances allow it. Instead of putting money in for 6 months and hoping it has grown significantly, the idea behind these investments is to leave it in for years, if not decades, and then withdraw it when you're ready to buy a house or retire. Last night was a great time to make an investment during my research. I kept running into that. You need to start investing as soon as possible, and once you've done so, you shouldn't touch or even glance at the money you've invested. Instead, just sit back and watch it grow. If you don't trust yourself enough to be able to time the market, you can simply put a small amount of money each month into an investment account and not touch it. As a result, let us now delve deeper into the world of stocks and their potential for both high risk and high reward. Most people have heard of people making money by buying a particular stock at a particular time, such as Apple, or some other stock you've never heard of. So when it comes to investing, stocks are a more risky option, but the rewards can be so much greater. It's a lot more difficult, and it's going to take some time to learn that the rewards can be enormous. It's also important to keep in mind that stocks in general tend to rise, but there will be dips, and it's likely to rise 2/3 of the time and fall 1/3 of the time. In order to get a better sense of the stock market, there are some great apps out there that allow you to invest a small amount of money, so you can get a better sense of what you're doing and become more comfortable with the process of investing. Investing in individual stocks may take more time and effort, but it is worth it if you are willing to put in the effort and is serious about learning. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.